Welcome to the Real Estate Investor Podcast. I'm your host, Gary Lipsky of Break of Day Capital. I talk to leading experts to discuss a wide range of subjects to educate investors on best-in-class practices to build legacy wealth and positively impact communities. Let's jump in. Hey everyone, welcome to another episode of the Real Estate Investor Podcast. I'm your host, Gary Lipsky with Break of Day Capital. Be sure to join our Facebook group, Asset Management Mastery, where we have a great community of thousands of like-minded individuals sharing resources and best practices.
Choosing the right insurance coverage for multifamily properties isn't that complicated if you know who to talk to. At the Garzella Group, we're uniquely qualified to help you navigate the range of policy choices you have, and we're committed to saving you 30% in the process. We do intensive market research and have nationwide relationships, so we can find coverage other insurance brokers simply can't. We should talk. Go to quotenow.biz and we'll start the conversation.
Today on the podcast, we have a longtime friend of mine, Powell Chee. Powell owns 16 self-storage facilities, which total over 5,000 units and over 650,000 square feet, and 7 multifamily properties totaling over 1,000 units. Powell also has 2 master's degrees and has bagged a prestigious Circle Award for a Fortune 500 company. Very impressive, Powell. Welcome to the show. Can you start by telling the listeners a little bit more about yourself and what you do?
Yeah, absolutely. Appreciate it, Gary. Thanks so much for having me on this as well. And good to talk to you all the time. Anyway, so yeah, a little bit about me. So, I grew up in the San Francisco Bay Area. Went to college in UC Santa Barbara. Eventually, once I got out, I decided that to enter the field of athletics, which is what I was in. I was a coach in athletics for a number of years. And then I'd really transitioned from that athletics coaching positions into sales. And then when sales brought me into real estate, because I was actually making a decent amount of money in sales, but I never really knew how to do real estate. And my father, who lived in the San Francisco Bay Area at the time, and still does, and was always like, you guys got to get into real estate with me. We got to do real estate together. And he had bought and sold a couple houses and small apartments during his time, but I never really knew how I would be able to do that. I was like, how am I going to be able to do this when, job wise, I wasn't making enough money to afford to buy, at the time was like a $600,000 house. And I was like, man, how am I going to really be able to afford to do that? And so that led me on the path to learning how to invest out of state, right? And that's what brought me to investing out of state and then buying a multifamily out of state. And that was when I bought my very first one in January of 2021. So I lived in Los Angeles at the time and bought my very first one. And that was a 40-unit property in Indianapolis, so totally across the United States. Then got really involved in more multifamily properties. So I was heavily involved with on the general partnership side of 7 different deals and 5 different syndications. That brought me to January 2020, right? And then what happened with everybody during 2020 was COVID, right? COVID put a kind of a stop on a lot of what was going on with just the normal routine. And at the time I thought, I'm probably going to pause on buying any more multifamily for 6 months at least, just with all the different laws that were changing. Lending was all over the place. Nobody really knew what was, if this was going to be a 2-week thing or, a 5-year thing. And so I decided to add a different asset class to my mix because I said, well, if I'm not going to buy any multifamily, I might as well take a look at other asset classes. And that asset class that I chose was self-storage. So I'll pause from there, and I'm sure you had other topics we could talk about. Mm-hmm.
It's funny. I've known you, I don't know, 6, 7 years, but I didn't know about the coaching piece. And I wish my father talked to me about investing in real estate. They never once did any family member talk about that, the benefits.
Mm-hmm.
And certainly I got into it much later in life, but wish I started much earlier.
I think everybody says that too, right? We wish we started earlier. I wish that, that we were present enough or exposed or willing to do it, and wish we started, decades earlier for sure. I'm in that same boat as well.
So talk about the differences between multifamily and self-storage.
hmm yeah, and there are a number of different things, right? It's I tell people at first it's very similar in that it's real estate, right? And so you're dealing with income. A major part of it is rent, and then you're dealing with there's ancillary ways of making income as well. But after that, you have your expenses, which are very similar to multifamily, property taxes, insurance, utilities, property management. So you have all of that. But once you start to dive into it, there are subtle differences that say multifamily will concentrate more on having, because it has more expenses in this way. Self-storage has less expenses in that, but more expenses in another category. And so you just have to learn, like, what are those kind of subtle differences, and why they are the way they are, and how you can minimize them is really kind of the name of the game in terms of expenses, and in what ways can you grow. But on a more I guess, direct way of like differences between multifamily and storage is that I tell people storage is managing people's stuff. Right? When you're doing with multifamily, you're dealing with people, right? Not their stuff. So there are a lot more laws that are like in favor of tenants in a lot of states. So we both live in California, so we know on the West Coast it's much more tenant friendly than it is in the middle part of the United States in the South. But when you're dealing with people's stuff, you don't really have that same divide, right? You think about it. If I have a bunch of stuff, Gary, like I have a bunch of couches and a car and whatever, and TVs, old TVs, and I'm going to put it on your property. Most people, and I would say 99% of the United States, is going to feel the same, that if I put it on your property, you're not going to be like, I don't have the right to just say, hey, you know what, I'm going to leave it there, and you have to leave it there, and I don't want to pay for it, just leave it there. And most people in the United States will say, you know what, you're going to have to pay for that, or that owner is going to be able to just get rid of that stuff. You can't just leave it on their property, right? That's their property. And that's the way that the laws kind of work, is that, hey, you have stuff on our property, you are going to pay for it, or we are going to get rid of it. And even in landlord-friendly states, this is still the case. And so you have laws are much more in favor, because these are lien laws; they're not eviction laws. So they don't, it's not dealing with putting people out on the street, or removing them from their residence. You're talking about their stuff, right? And then managing people's stuff is a lot easier, right? Their stuff doesn't cause a lot of the issues that you have with dealing with people, right? It doesn't move around. It doesn't open the door up and down. It doesn't wear out the carpet. It doesn't break your faucet. It doesn't do that. It's just there, and you got to pay for it, right? Or remove it. So the management of it becomes a lot easier and that can be seen as, when we look at, you just look at like general rules of thumb, and just kind of a general rule of thumb in multifamily. When you get into sort of the larger multifamily, you may be running when you're evaluating a deal that you don't know much about, you probably use a rule of thumb of probably 50% or so expense ratio. Would you say that's fair, Gary?
Yeah, depending upon the region, I would say higher in Texas and lower where we invest in Arizona, because we don't have the crazy insurance costs and the real estate taxes.
Yeah, for sure. So you have sort of a general rule of thumb, and I'm just kind of using across the United States. So I just say 50% just to make it easy.
Yep.
I think that's pretty safe to say. So use that for multifamily. 50% of your total income is probably going to go towards expenses if you're at a stabilized rate already. Okay. In storage, that kind of general rule of thumb, again, it's not true everywhere, is going to be 40. So like 40% of your total income is going to go towards your expenses. So you already have a 10% buffer there. And that's because the management of this is just much easier, and there's less cost involved. And so those are some of the ways I would point out that storage has some benefits over multifamily. I mean, the main benefit that I see with multifamily is that there's much more of them. I mean, if you take all the storage properties in the whole United States, there's probably like 100 times more apartments than there are in storage, right? Yes, there are storage facilities all over the place, but you can walk down any street, and you find like there's 10 different apartment buildings that are, they can vary in size, I know, but there's going to be a lot more apartment buildings out there than there are going to be storage facilities. So
I'm curious. So, depending upon which article you read, we're about 5 million housing units short in the U.S.
mm-hmm.
How many units short are we for self-storage?
And I guess one of the differences between when you're evaluating self-storage and multifamily is that multifamily is a little more macro. You're looking at macro markets. You're looking at really the macro MSA. And what is that MSA doing? Is it jobs coming in or jobs leaving? And what's the job diversity and what's the affordability of this MSA in general? Because people are going to live and probably move around in that MSA. Storage is really micro market based. So you're looking at really the 3 to 5 mile radius around your specific location. So you're looking at what's the demand in my area. Not so much like what's the demand across the United States or even across the city doesn't really impact my 3 to 5 mile radius. Right. So you need to be able to target, specifically like your micro market. So it could be a situation where in my 3 to 5 mile radius, it is oversupplied. There are 7 other big properties and it's just, there isn't that many people in it. And so it's oversupplied. But if you just go across town, maybe it's undersupplied. And then you could find a unit or a storage place to buy that, hey, there's not much competition and there's a lot of people here and the rates seem really seem to be pretty high. That might be a very good buy. And so you could say like in the same city, you could find these kind of pockets where storage would be undersupplied and when there's other ones where it would be oversupplied. Okay.
What other criteria do you look for in a self-storage play?
So for me, I'm looking at value add, right? So I'm looking at value add and I have 4 different ways that I'm trying to add value into my storage facility. So the things that I'm looking for are low occupancy. So we bought a couple properties that the occupancy was 65%, 55%. I think 55% was the lowest I bought one. And that, you buy a multifamily property and it's 55% occupied. It's not going to be covering the debt. It's a heavy value add, right? That's pretty heavy value add. Occupancy, low occupancy, low rent. So if you look compared to the market, in self-storage, you can still find some properties that they've been operating for the past 7-10 years, pretty much kind of like a mom and pop where they just want to stay 100% full. So they don't raise the rent and they haven't raised the rent. Maybe they've done it twice in 10 years, right? And it's $5 or something. So when you look at their actual rent compared to the rest of the market, they're charging, $70 for a 10 by 10, whereas the rest of the market is charging like $110 or $100. And that's a $30, $40 difference, right? And that can be across the unit mixes. So I'm looking for things like that. Low rents, expansion possibilities. So I'm looking for, hey, is there extra land or is maybe the land that the way that they built everything, or maybe they have a bunch of parking spaces that are not organized and maybe we can put extra storage units there, or maybe there's ways that we can put portable units down somewhere, or in what ways can we expand what's currently there and using expand from what's currently there. So looking for those possibilities and purchasing another lot. So I've done that where I purchased an extra lot that was right next door a couple times. And so there's that possibility. And then the 4th one is operational inefficiencies. So the way that we run the properties is not necessarily the same as the way that traditionally has been run. So we operate unmanned. So that meaning our facilities don't have somebody in the front office, whereas a traditional office will have somebody there staffed. And because we run this way, we have certain operational inefficiencies that we see in the properties that we buy, and we can reduce our expenses very quickly. And so those are the 4 areas that I'm looking for in terms of what am I looking for in a self-storage facility. I'm looking for those. 1, or a combination of those four ways to add value in a property.
So I'm curious on the lots that you bought next door to your facility, what have you done with it? Because sometimes we see that with multifamily, like there's an extra lot, but it doesn't necessarily align for our play, because it could cost, 200 to 250,000 per unit to have like, build 40 new units next to, maybe a 1973 product. So I'm curious what you've been able to do with the land or potentially.
Yeah. So we haven't, so the two places that we've bought land and we also had extra land there, we haven't done anything with them except for zone them. We've zoned them correct so that we could build storage on them. So that was kind of the first step, is just to make sure that they can, zoning wise, that they're going to pass. And so our options right now are, do we build more storage? We may also build more of like, RV and boat storage, right? Kind of make an addition to that. So it's not just pure storage. So there's kind of a hybrid there. We're running a couple different things of, do we want to build, brand new climate controlled and make it maybe not one story, but two story. So we have the options right now. We just haven't executed on. Really, we decided that we'll go ahead and zone these, get them zoned correctly, making sure that it passes that. And then we'll decide what to do. Right now with kind of development and interest rates and getting construction loans, it's a little kind of a dicey area right now. So we're not just going to just dive in until we feel like it's a good time to do so.
Got it. I've been really impressed. You've scaled your self-storage business really fast. And so what were some of the key things that allowed you to, or helped you 10x your business?
Mm-hmm. Yeah, I appreciate that. So, I mean, in I guess 2.5 years, we've went from one property that we bought, our very first one we bought, we didn't really want to tell anybody, right? Because we were all multifamily and, you and I were going to all these meetups and knew our networks, and everybody knew us as multifamily people. So I didn't want to tell anybody, hey, I'm going to go buy a self-storage facility, because they'd be like, what are you doing? And so I just bought it with a small group of mostly my family, right? And a few friends. And we bought a kind of a small one just to test the market. Because at this point we thought, hey, we like it. We think this is great. We've done a lot of research and we've evaluated deals, but we really don't know if this is going to be true until we put it into practice. So let's go buy one. So we bought one. And as soon as we bought it, we realized really quickly, this is going to be good. We can scale this. Let's go ahead and tell the rest of our network and let's go ahead and move forward. So good thing for me is at that point, I had already built up a pretty strong network of multifamily investors, people that were very interested in multifamily. At this time, a lot of people were curious, like I was, about storage or about other asset classes, and I just happened to choose storage, that they were willing to be interested in it with me. So they not necessarily that they are diving into storage automatically, but they were saying, you know what, I love multifamily, but I'm willing to diversify into a different asset class. And I don't want to put all my eggs in necessarily one basket. And I've heard that you do storage and trust kind of what you do and build this relationship over years. So I'm willing to go ahead and invest in some of your self-storage deals. I'm very interested in that. So I have a lot of investors who are really primarily multifamily investors, and they just have wanted to diversify. And so they're open to it. And I think most people sort of coming out of the pandemic, have been a lot more open to other asset classes. They've loved multifamily. I do too. Go for it. But they're just like, yeah, you know what? There are some other asset classes that are doing pretty well too, and I'm open to diversifying within commercial real estate. So that's what that's a big benefit to me, as well as the team. I mean, truthfully, it's not that I do everything. I don't want to come across and say, hey, I do everything and I'm doing all this stuff and it's just me. No, I have a great business partner, and we have a great team behind us. And we've kind of built out that team. We've had other partners in the past that have really helped us on many different levels. And so it's just been a really a group effort. And so I just happen to be one of the people that's sort of in the front of that. So,
well, kudos to you. And the timing was great because people were very fervent about multifamily, and that was the perfect time to kind of get them over into a different asset class.
Mm-hmm. Mm-hmm. Yeah, it's worked out well, and I have a lot of people that have, just did exactly that. They love multifamily, but they're interested in another asset class, and they just needed somebody that was a trusted operator that they felt like understood them and now understood that asset class, and I could bridge that gap for them.
Let's talk about a recent deal you took down, because I know the story, and I know it shows tremendous patience and perseverance, and I think that any investor out there can apply it to anything. And so, walk us through that deal, because it was a beginner operator probably couldn't have pulled it off.
Okay, sure. And I assume we're talking about the Beaumont deal, the portfolio deal, right? That's
the a month. Yeah.
Yeah. Okay. So I mean, this deal took almost a year to do, right? Almost a year. And this is probably in, I think it was late June or July that I put it under contract last year, 2022. Okay. So if you remember what's going on during this time is that interest rates are climbing, right? And they're still climbing. Right? So I think they hiked up in January of 2022, but there was a big hike that came around June or July. And I think there was maybe even 2 hikes in July. I can't remember exactly, but we put it under contract. And it's basically a 7-property portfolio. It's in Texas. It's in Beaumont, Texas. So if you happen to go to our website, you'll see that in Beaumont, Texas, we have 7 properties out there. And this one was, so we went out there, visited the property, and everything, we felt like, hey, this is what we're looking for. Value add. There's a lot of value add here. Occupancy is pretty low. Rates are probably in line with the market, so there's probably not much room there in terms of rates. But there's expansion possibilities, and we feel like it's just got a lot of potential at these properties. So super excited. And then what happened is, we were planning to do it in a way, structuring it in a way that we had for an equity groups involved, and we were going to joint venture all this. It's because that's what we did before. However, as the interest rates started climbing, right, and they started climbing really fast. So June, July, August, September, there was another one, and there was another rate hike again. And at this point, people started getting really, really, really nervous. And this is when we were starting to have to we're planning on closing the deal, right? And we had a lot of, so we went through a lot of different lenders. We went through, first we were looking at CMBS and life insurance companies, and then we were looking at bank loans, credit unions, debt funds, private lenders, all this time, as well as we had for equity groups involved. And all of this started to really just crumble and fall out. So as we get to October, November, December, they all started disappearing. Everything started disappearing. Nobody was lending. All the lenders at this point were like, hey, it's the end of the year. We're going to stop lending at this point. We're going to wait till 2023. And I was like, that's not good. I mean, I'm having to extend all the extensions, putting down more capital, working with the seller as well, because obviously he's trying to sell this as soon as possible. So you're negotiating all these things, going back and forth. But luckily I was able to extend them and work with the seller, who is a great guy, and I appreciate him working with us the entire time. And so we were just trying to get all the lending in place, and that was just a situation where it looked pretty bleak. I mean, there were multiple times that I was like, we're going to lose all of our upfront capital, all of our earnest money. We're going to lose it, and we're not going to get this thing done. So a lot of those groups just fell out. Well, a lot of them, they kind of gave me the nice way of saying no, right? It's like, yeah, we can do this. I think, and a week later, nothing's happening. We're applying for their loans, and there's no progress happening. We were asking, when is the loan committee going to meet? So I did get a lot sharper when it came to talking to them about, is this deal really going to happen? Because, you start to ask certain questions, and if they can't answer these certain questions, then you know that something's going wrong, right? And so that all happened. That brought me to like around the Christmas time, and I was like, this is gonna. I mean, we're almost done here. We don't, we're January 10th was kind of our the time we were going to close, and we weren't really close to it. All the capital in terms of raising capital was tough. You're trying to raise capital during Christmas time, and that's not, you already know that's not a good situation. So brought us to the new year, and we had to renegotiate at this point. And I was like, look, we've had multiple rate hikes during this time. I didn't ask for any concessions or anything, but truthfully, the property is just not worth as much as it was in July when we put it under contract. And so we had to retrade it. And so we retraded it. We got a pretty significant discount, and we got a extension was what we needed. We needed really the extension. And eventually, we kind of shifted gears with our lenders, and he also decided that he would shift gears, and kind of didn't tell us, but he ended up helping us by him doing some kind of seller financing really doing some seller financing on this. So he didn't tell us about it, but later on, when it came to the actual close of the deal, so I'm fast forwarding basically till April, May. There was also a fire at the property. So I didn't mention that. There was a fire at the property. It burned an entire building. And so in our contract to extend was, hey, he needed to deliver a brand new building for us. So we wouldn't close because the lenders are not going to close, or we didn't want to close. This was as much as the lenders don't want to close with a half-built building, and the contractors are getting half paid from them and half paid from us as a huge headache. So we'll wait until he delivers the whole building before we close. Finally comes around about that time to close, and he presents us with a seller financing deal. Like we had lenders kind of lined up, and it was like, he presents us with a seller financing option, and we were like, this is a really good option. We need to take this. So we ended up taking the seller financing. So it's a case where this is the largest seller financing deal that I've ever seen, or I've ever been part of, right? So we did it. We did it. We closed the seller financing. We had all the capital raised. We had our strong team together. I will tell you that it was like I said, many times that I thought this deal's going to die. All right, this deal is not going to make it, but we made it eventually, and we got it. And now we're in that transition phase where we're taking over and working on the full transition. So yeah, super happy about it.
Congrats. And people post on social media all the time, yay, we got a deal, but a lot of times there's so much blood, sweat, and tears that you don't hear about that goes into the closing a deal. That's why people are so happy when they do. But then obviously the real work begins. But kudos to persevering and getting it done.
Appreciate that. Yeah, you're 100% right. There's a lot that goes into it, and a lot that went through this for sure. But I'll tell you that it certainly made us stronger, right? I mean, I'm a lot sharper when it comes to the lenders and understanding like whether or not it's going to happen with them, and whether or not they're really being, they're going to get the deal done or not, right? And also in terms of just putting deals together and working with sellers, negotiations. I mean, when you're negotiating all that stuff, and it's not easy to negotiate. Like, hey, we need more time, and also we need a discount, right? And it's like, for what? Wait, you need a discount and you need time? I was like, are you gonna really be able to do this? So there's a lot of delicate balancing act that I certainly got better with.
So I got one last question for you. What's that key thing to ask for to a lender to really know if they're for real or not?
Okay, so two things that I think. Okay, so one is you got to find out how fast they're getting the reports. Like, are the reports ordered, right? So sometimes they're going to say, yeah. They might say, yeah, we like this. We're going to still meet on this. Get this in to us. We're waiting on you to get this paperwork in, whatever. But once you put down your down payment, and like, when are those reports being ordered? Like, I want to know, and like, how soon are they going to be out there, and how soon are they going to be getting back? Because you're going to delay on that, right? And that's going to affect your, when they're going to be able to fund. And the second thing is you got to find out who is the committee that is deciding on this deal, and when are they meeting, and when am I going to find out their decision, right? So, those are, I guess, two initial things that, I just kind of thought, hey, the person I'm talking to, the loan originator, he's saying, yeah, 100%, they're in, but they're not the loan committee. The loan committee is the team that's saying, no, we're not going to do this deal. We're not going to do any deals till, January of 2021, 23 or whatever. They're the ones that are saying that you need to find out when are they meeting and what did they say about my deal, right? And you're going to get a commitment from them.
All right, excellent. So Powell, appreciate you coming on the show, adding a ton of value on self-storage. Where can listeners find out more about you and your company?
Sure. The easiest way is to, if you want to email us, you can email us at invest at radiantstorage.com. Okay, that'll come to myself and my team as well. So invest at radiantstorage.com. If it's me personally, if you're interested in just following what I do on social media, Instagram, you can look me up on Instagram. I don't know if any other Powell Chees out there. So look me up on Instagram, Facebook. I also post here and there to LinkedIn as well, but I would say Instagram or Facebook are great ways to get in touch with me or follow me there. And I'd love to connect.
Awesome. This is Gary Lipsky signing off. I'll be back next week with another informative episode on the Real Estate Investor Podcast. To all of our listeners, thanks for joining us. And if you like this episode, please head over to iTunes or Stitcher and subscribe, and leave a review, as it will help us reach more people. And if you'd like to learn more about what we do at Break of Day Capital, head over to our website at breakofdaycapital.com and sign up for our newsletter and fill out our investor application. We'll talk to you next week.